Okay, in this video, I'm going to be telling you why most who calculate if they should overpay or invest get this completely wrong. And I don't just mean kind of have a go finance channels, so I'm going to be telling you pretty quickly. 1, why the maths is always going to be wrong unless you know pretty much everything about someone's situation. 2, why most of the explanations you see on this, how to work it out, are generally wrong. 3, why shockingly understanding the maths doesn't really matter to your choice, and there's a surprising reason for that. I'm also going to be telling you why thinking of a trip to the airport will probably give you the answer that you want, and trust me, this will all make sense later. Okay, so here's what most people do badly. So they go, mortgage rates have increased to say 5%, and that means your mortgage annually now costs X. Now, investments have historically performed at insert paper from asset manager with a return of Y. So let's just flesh out the figures at time of recording for something like that. So the average 2-year fixed at a 90% loan to value is about 5.6%. Now, average equity returns are between 6.2% and 8.2% according to Vanguard's paper before inflation. The historical average since 1900, according to Credit Suisse, is 6.7 for after inflation for the US and 4.5 for the world ex-US after inflation again. So an estimate to work this out is basically return estimate for Y, the investment, against X, which is the mortgage cost, and that is your arbitrage opportunity. Simple, right? Wrong. And I'm going to be telling you fully why. But first, let's discuss why the differences between mortgage rate and future returns are so heavily linked. So mortgage rates are heavily impacted by what's called the risk-free rate. Basically what central banks are offering as returns on loans to government, treasuries in the US or gilts in the UK. And it's not just this, and I've done a video which references swaps, which you can have a watch if you want a bit more of a deeper dive. Now, unfortunately, investments are also heavily impacted by the risk-free rate, be it stocks, bonds or property. Asset prices are based broadly on the discounted rate of future cash flows, and here's a formula for calculating the asset pricing model. And this model is the closest thing we have in finance to asset price DNA.
DNA strand like me.
This formula is just a fancy way of saying the value of an asset is relative to what it will produce in the future against the risk-free rate, those loans to governments. Then those cash flows, those future earnings, are discounted back to the present day, which creates the price. Huge oversimplification, but it's the concept you need to get your head around. And you might be fairly thinking, oh, why does that matter? Well, because as the risk-free rate increases, asset prices can often decrease. Because if the government will now offer you 4% as a return and the government is extremely unlikely to default, as they can just print more money, then the risky stock or bond that you're holding giving you 5% isn't looking so good now as an investment. And why would it? Because you're taking a ton more risk compared to what you can get from a risk-free asset. And side note, what I've just explained is basically why tech stocks declined so much in 2022. So what happens in investment markets, which adapt and fluctuate all the time, is that the price corrects down to factor this in as far as asset prices. And all of history shows us that when a diversified investment decreases in price, the expected future value increases. So what makes this decision so tricky is because at the time where it makes sense to pay off a mortgage due to rising interest rates is also likely to be the time where expected future returns are rising on investments. So let's take Vanguard's capital market assumptions, and you can see as the bear market last year continued, the expected future returns of assets started to rise. And if we focus on the second column here, which is global equities, in the dark yellow, you can see where we were in December 2021. And the range as global markets took a hit in June 2022 and then took a further hit in September 2022 as expected returns rose further. So why is the napkin math, which all seemingly use, so wrong? Okay, so credit where credit is due. These, as always, aren't my ideas. This is one of the best papers that I've seen on this, and it's from Honest Math. And it basically says, the popular heuristic of comparing one's mortgage interest rate against one's portfolio return to determine the cost or benefit of mortgage prepayments is flawed and misleading. The napkin math, commonly used by finance professionals, academics, and pop finance gurus, I'm listening, fails to consider the impact of leverage, volatility, and sequence of portfolio returns. Yeah, absolutely. Okay, so let me go over this and explain a bit more detail, while the maths that so many other YouTube channels might talk about you're using will probably be wrong. So let's think about the concept. Paying off a fixed rate mortgage is a fixed and guaranteed return compared to what you would have paid. But mortgage rates change over time, so you need to know the variability of UK mortgages and what they're likely to be, which we don't know. Now, unlike the US, where they have much longer interest rate periods, we in the UK don't really. It tends to be 2 or 5 years you get on a mortgage. And as I just explained a few seconds ago, the dynamic between interest rates and expected returns is interlinked. The second point is investing in stocks is volatile, and volatility is compounded when you borrow money for any reason. And the leverage you apply with a repayment mortgage diminishes over time. And this amplifies sequence of return risk. So if we think about, if you have a mortgage that you've just bought a home with a 10% deposit, your exposure to leverage is 90%. Now, if you flip that round and you now have 90% equity in a property and just borrowed 10%, your exposure to leverage is much less. And this matters so much as, all things being equal, investment performance during the earlier years, where you might have the most leverage applies, matters the most, while performance during the later years matters less. So you came here for nerdy finance talk, so let me give you some finance conclusions here. So anyway, what they found in the paper that I referenced earlier was that in the US market, for the back test on overpaying or investing, it was basically the same whether you'd overpaid the mortgage or invested. However, the model they ran looking forward basically favoured paying down the mortgage instead of investing, quite heavily as well, which is interesting. The thing to bear in mind, though, for us in the UK is that the US market is very different from the UK. And in the US, they've got really long dated mortgages. So effectively, that's going to have a big difference in the UK. So for us in the UK, let's do some rubbish napkin maths. And with some heavy assumptions, let's just assume a few things. 200 grand mortgage rate's now around 4.5%, which is give or take about right. You've got 15 years left on the mortgage, repayment mortgage, and you've got £200 per month spare. We're going to have to assume that returns and interest rates stay the same throughout the period because, as I mentioned earlier, we don't know what they're going to be. And you want to know, should I overpay or invest? Anyway, these assumptions assume you're comfortable investing in global equities, and also you've got an ISA where you can put some of the investments into, so no capital gains or income tax. We're also going to use the 7.2% return expectation from Vanguard's paper. So in paying off a mortgage compared to not overpaying, you've saved an extra £42,918 by saving a mixture of capital and interest. Of that, £12,718 is saving on interest alone. Anyway, investing in the ISA gets you £63,610, so it wins based on those assumptions. But if you were to use a lifetime ISA and take advantage of the bonus, and you were of the age to be able to do that, and you said you were going to pay the mortgage off after age 60, which isn't actually unreasonable for a lot of younger individuals because they tend to be buying properties later now. Anyway, because you get a tax bump, you'd actually have £79,512. If you're a higher rate taxpayer getting 40% tax relief and allocate your payment into a pension using your tax-free cash, that would give you £106,006. However, the big risk with both the lifetime ISA and the pension is that legislation can change. But I'm more inclined to think it would more likely to change on the pension than the lifetime ISA. Basically, it's only £4,000, so I don't know, I can't see them attacking that, to be honest. But that's just my view. Now, we could take a stab at including house price growth to compare the paper gain, but look, that's only really relevant if you want to sell. So I think focusing on house price appreciation isn't wise unless downsizing is a specific part of the strategy. Okay, so there you go on the maths, but seriously, I want you to ask yourself a question, because actually the decision and what you want to do is something you might know the answer to already. And I'm going to reference a fantastic book by a guy called Rory Sutherland, one of my favourite books. It's called Alchemy. And he basically dives into human decision making. And he uses an example, which I'm going to talk you through, about making a decision about how to get to an airport. So put yourself in the position of taking a journey to an airport for a long and important flight. You've got options for travel. One, you take the motorway, which is quicker. It only takes about 25 minutes to get to the airport. But every so often, there can be a huge traffic jam, you get stuck for 90 minutes and you potentially miss your flight. Now, the second option is the windy back roads, which gives you lots of options in where to turn off. You've never been stuck in your decades of traveling down the windy back roads because there's side roads you can turn down. The catch is, the journey is much longer because of it. So the numbers, just to throw this out, are 1 in every 5 of your journeys to the motorway, roughly, you get stuck in traffic for an hour and a half, and you potentially might miss your flight. The other 4 journeys take 25 minutes, whereas pretty much every journey down the back road takes 45 minutes. So I just want you to think and be honest with yourself. When picking up your bags about to go on your holiday, which one do you take? So let's do the maths. The motorway journey has an arithmetic mean of 38 minutes. That's what most people think when they think of averages. Or a geometric mean of 32 minutes. So either way, when we cut this, the mathematical and logical decision is always take the motorway. And if this was a game, you would have a significant advantage just always playing the hand of the motorway. The expected return of the motorway is higher than the back roads. But I would hazard a guess that there are a significant proportion of you who are watching this video who would, given the choice, the windy back roads was a no-brainer. And that's because it's not really the time we're focusing on, it's the uncertainty of the outcome. For most of you, for 20 minutes, let's be honest, having a mosey around duty free is probably worth the cost of the uncertainty around missing your flight through the route. And what I think is interesting here is that might sound maybe irrational. But if you think of it from a human evolution standpoint and behavior, it makes perfect sense. So kind of like our ancestors trying to survive, the person who worked out, actually, I don't fancy taking the chance on whether that is lying in the bushes. And I'm not saying this to give you a blank check to decisions which discount probabilities and outcome. I'm just saying that our brains are quite good at understanding the difference between probability of outcome versus asymmetry of outcome. So when we take it back to this mortgage decision, the question you've really got to ask yourself is what's more important to you? Is it maximizing your return or maximizing your certainty of outcome with your home? Because basically you've got 3 options, haven't you? You can use all your spare money and overpay, you can use all your spare money and invest, or you can use a mixture of both into whatever degree you want. Ultimately, the decision that is right for you may not be the same as the decision that's right for somebody else, even if the maths and logic are the same. I think it's important that we have to recognize there isn't a perfect answer here. But there might be something missing, mortgage rates. And let's be honest, that can have a huge impact on your finances. And if you want to protect yourself properly against a mortgage crisis, I'd suggest you watch this video.